My name is Jarrad Mahon. I'm the Director and Property Specialist at Investors Edge Real Estate, and welcome to another one in the series of landlord tips on, what's the tip called again, Justin?
We're maximising your insurance cover without affecting your cash flow.
Yeah.
Sort of where we're heading today.
For sure. And cash flow for investors is one of the most important things. We want to do everything without hurting that. So most of our focus is always on how to build our portfolio and grow that to be as large as possible to secure our future. And good debt is a fantastic instrument for growing our assets and being as leveraged into the market as possible. But we don't often pay much thought to what will happen if tragedy strikes. And I myself have always just been gung-ho with growing my portfolio and never really, I've taken the basic property insurances out, building insurance and landlord protection, but never taken insurances out over myself. So today I'm joined by Justin McMillan from RI Advice. He's a financial planner who specialises in helping property investors adequately cover themselves with insurance. And we're going to blow apart a few misconceptions about insurance and just show how property investors can really make use of it to cover themselves and their families. So what are the types of cover property investors should be considering and looking at, Justin?
When it comes to personal insurances, there are four major insurances property investors should look at. One is life cover. So if you pass away, your family is not left with either a debt or having to sell assets at a low price. Basically, they can continue on with your portfolio and enjoy the benefits of that. Then you've got total and permanent disablement, which is normally referred to as TPD insurance, and that's a rider to life cover, normally associated with life cover, and that's basically if you need near death. Yep. You've lost two arms, two legs, gone blind, basically never going to work again. Yep. Is TPD cover. Then we've got income protection cover, which provides you with an income stream if you are unable to work due to sickness or injury. So basically supplements your income while you're unable to work. And then the final insurance is trauma cover, which provides a lump sum if you're contracted a major traumatic event, such as cancer, heart attack or stroke. So it gives you a lump sum cover to one, pay for medical expenses, and also may allow your spouse to take time off work so they can look after you, because obviously their income protection won't cover them.
Yeah, unfortunately too often in my job as a sales agent, I see people at the other end when they're having to go through these times, and it's stressful enough when you lose a family member, but to be forced to sell something or to split up your portfolio because you can't afford to carry it forward is, it's pretty heartbreaking for me to see that. And I guess this is what planning ahead is all about. None of us want to think about that happening to us or to a loved one, but if we can plan it out, then it'll certainly make that time a lot easier, won't it?
Absolutely.
So, one of the common misconceptions for me is that insurance costs a lot, and I don't want to be hurting my cash flow. So, what are our different options with how we can finance the insurance and how we can pay for it?
As a financial advisor, I come across this dilemma with clients every day, and luckily for them and luckily for the viewers today, I've got some solutions for them. First of all, the first solution is the life and TPD cover. Primary can be held through superannuation.
Yep.
So instead of it coming out of your cash flow, it just comes out of your superannuation account balance. And this can also apply for income protection insurance. Alternatively, for income protection insurance is also tax deductible. So if you do hold it in your own name, you will get the tax deductibility on the premiums. Yep. So that can also affect reduce the cost as well. But looking at your super fund and looking at that as holding your insurances would be the first point of call if you're looking to hold significant insurances to protect your family without affecting your cash flow.
Yeah, great. Well, I for one didn't know that was even possible to do. And coming, from the younger space, and even as you get older, it's great to make your superannuation, work harder for you in the sense that it's also providing you with
added cover. Absolutely, yeah. And obviously, you don't have to keep the same level of cover throughout your life. So obviously, as your asset position rises and if that position falls, this can be reviewed on an ongoing basis. So while you're young and while retirement is a long way away, you might want to look at your super as sort of your insurance vehicle, and then as your assets outside of super grow and your debts reduce, you may want to reduce the cover and then start using your super as more as a wealth accumulation vehicle for retirement.
Yeah, great. So, will your superannuation be adversely affected at all by, putting your insurance cover in it?
Yeah. So, with the insurance cover inside the superannuation fund, the premiums will be paid from the superannuation fund. But if you look for a typical 40-year-old male, white collar, non-smoker, if you're looking for $1 million worth of life cover, you're looking somewhere around about $50 to $60 a month. So if you have a superannuation portfolio of 100,000, you're looking at somewhere about $600 of that a year going into insurance premiums for the year. So you're looking at about 0.5% of your portfolio will be diverted to your insurance premiums. So if your superannuation is also constructed correctly and is outperforming the market, obviously, some of the outperformance is just going to go to insurance premiums. So you're no worse off. So
and 0.5% should be quite a drop in the ocean as well.
So $600 a year for $1 million worth of cover. So if you pass away, your family has $1 million. That's a fair return. One would think.
Great. So what should our clients watch out for with insurance inside of super? Is there any pitfalls and things to be aware of?
Yeah, absolutely. Every every superannuation account is different. Each superannuation provider has their own trust deed. So the trust deed basically dictates what you can and can't do with that particular superannuation fund. So for income protection argument's sake, some superannuation funds will only pay if you can't do any of your work. So if you're a real estate agent like yourself, Jarrad, and you can still sit at a computer and type, but you can't go out and see clients and things like that, they will not pay out. Now, if you can't go and see clients, it's obviously going to adversely affect your profession, your work significantly, but they still won't pay out. While others will pay out if you just can't do one of your particular tasks in your work, exactly. So the trust deed is critical to basically holding your insurance inside a super. So that has to be reviewed pretty thoroughly. And as we probably all know, we've had the superannuation PDSs, there are 100 pages of things to go through. So it's critical that you seek professional advice when looking to do this.
So is this for people that have their super with industry funds and other stuff as well, or is it only for the people with self-managed super funds?
Both, particularly the industry funds. You have to look very closely at their insurance offering because of their low fee structure. It's normally a situation where if you can't do one of your particular situations, then they'll pay. Whereas most of them you can't do all of your tasks before they'll pay. Compared to most funds, you only have to do can't do one of your tasks and then they'll pay. Within your self-managed super fund, that gives you great flexibility as far as holding insurance, because then you can go to the marketplace and basically get your own insurance with your self-managed super fund holding the paying the premiums. But you can go to anybody out in the marketplace of towers, INGs, Astrons, Commonsurers, AMPs, and source your insurance through your self-managed super fund. So it gives you great flexibility as far as insurance.
We'll have to come back to self-managed super funds on another topic.
Yes, we will.
That's a whole kettle of fish in itself.
Absolutely, absolutely.
So, what can you offer our clients at Investors Edge who want to uncover their insurance options? What can you do for us today?
Yeah, exactly. So, like Jarrad, I also love property and I love helping property investors, and I'm also passionate about insurance and if something does go wrong, people can continue on with their lives and their wealth accumulation, their dreams and their hopes. So for investors with Edge's clients, we'll do obligation-free, no cost review of their insurances. Also, basically a first appointment to go through a needs analysis for their insurance and basically put them in the right direction.
Yeah. And I've been through this insurance review with Justin myself, and it was very eye-opening for me. It covers a whole, range of things that I wasn't aware of, and definitely worth every investor that we know taking this up. At the very least, it's going to give you your options, and with information, you can then make decisions.
Absolutely, yeah.
That's great. Well, thanks for joining us today, Justin.
Pleasure.
And I'm sure we'll see you in the next Landlord Tips.
Yes.
Make sure you sign up to our newsletter and Facebook group, guys, and I'll see you in the next video.
Thank you.